been Reppond. Welcome to my YouTube broadcast. Today is February 1, 2023. So I'll cover a lot of statistics, a lot of charts, really about the direction of the market. January has been an exceptionally good month for the market. It has gone up. Last year was a decline. The S&P 500 was down at its worst point about 24% and finished the year down about 18%. Just kind of, generally speaking, a year of decline. Bonds down a lot. Finished the year down about 30%. The long-term government bond down about 30%, and at its worst point was down about 35%. So, but now, in the month of January, we're off to a good start. Now, I'll show you the data, but I also want to caution you that we're glad to ride this wave. We'll ride it as long as it continues up. But it has gone up too much, too quickly to be sustained. So there will need to be a correction, in my opinion, in order to, my guess is it'll probably finish the year positive, but we will go through, some market cycles, short-term cycles during the year. So to begin with, the dashboard shows nearly everything, nearly every index is positive, meaning it's above its moving average, the 20, 50, 100 and 200-day moving averages, every one of them, except for the 20-year government bond. And it's above 3. When you break the S&P 500 down into the sectors that comprise the S&P 500, there are 11 of them. Most of them are positive, you can see from the green dots. And they go from consumer discretionary and retail, technology, which were the worst or among the worst last year, and now they're on top. And you can see the data, the year-to-date data on the second column, it's kind of in the middle, going from a gain of 14%, 13%, 9%, all the way down to healthcare and consumer staples, which are negative for the year. And the negative ones were the best performers last year. They weren't positive, but they were down the least. And now they are the worst performers. But sometimes that is just an example. Just this 1 month is an example of market cycles, of how the market goes through positive and negative periods. The S&P 500 is generally, since October, generally in an upward direction. Now, the month of late November, early December, there was a decline, but since that period of time, mostly the S&P 500 has been in an upward direction, as I indicate from the black arrow on the right, and it is above its 20-period moving average. I compare the growth stocks in the S&P 500 to the value stocks. The growth stocks are those that are oriented to sales and revenue growth, and value, those that are more oriented to being profitable. For this year, this past year, 2022, you can see from the black arrow that generally speaking, value stocks were in favor. Value is the denominator and growth is the numerator. So if it goes down, that's going to favor value. And you can see at the very end for 2023, that growth is starting to come back into favor just a little bit. But generally speaking, it's still a long-term downward trend that favors value over growth. When I compare small cap stocks measured by the Russell 2000 Small Cap Exchange Traded Fund, IWM, compare that, and that's the numerator, compare that to the denominator SPY, which is for the S&P 500, large cap stocks. If it goes up, that's going to favor small cap, and if it goes down, it's going to favor large cap. So you can see I drew a chart from really for about the last year. This is a 24-month chart. From the last year, it has been up and down and mostly not changed a lot, but it is slightly going up in an upward direction, favoring, therefore, small cap stocks slightly over large cap stocks. Long-term government bond. This is a 31-month chart, and you can see the two long periods of decline for the ETF, TLT, long periods of decline. Now, there has been some strength lately in the last few months that shows that it is going up. It's now above its 20-period moving average, but the long-term direction is still down. I would not say it's yet broken and started a new trend up. But the two long periods of decline. The dollar, this is a 20-month chart. The dollar, of course, is relative to other currencies, but it has continued to decline in value relative to the other currencies. And usually that is compared to either the pound or the euro, but probably other markets as well, Japan, Korea, Canada, etc. But it has been in a downward decline and is below its 20-period moving average. This favors investment coming into the U.S. from the outside. Their currencies are stronger now than ours, and so the more this happens, it'll favor foreign investment, but it will also disincentivize U.S. residents from spending money or investing abroad. Gold has been a strong precious metal since late October and until present. So you can see it has definitely moved up quite a bit, and this is represented by the exchange traded fund GLD. Silver, on the other hand, has not been, it's gone up, but it has not been as strong as gold has. So you can see it's kind of weakened a little bit and is not in the straight trajectory of gold. That's kind of an interesting phenomenon in an up market, because in an up market for precious metals, usually silver is moving up faster than gold. When I compare these two, put silver as a numerator and gold as a denominator, and you can see the exaggeration that still they're both up, but that silver is declining more than gold is, or it's going up at a slower rate than gold, or is declining more than gold. And so therefore you see the pullback at the very end. Now I'll take this moment to make a point. I'm a proponent of owning silver. I own silver. And I look at it, and I learned this from Jim Rickards in his book, The Death of Money. I look at it as an insurance policy against the decline or even eventual collapse of the dollar. And I hope I never have to use it. But if it goes up in value or down in value, I don't care. I really, truly don't care, because that's not why I own it. If silver goes down to $15 an ounce, I don't care. If it goes to $30 an ounce, I don't care. That's not why I own it. I own it because it's an insurance policy. I think of it like this. Okay, so I have food, a lot of food storage. So if I can't get food, then I have a backup supply. I also, I live in Montana, so I have a supply of wood. I've got about 15 cords of wood, and if I need them, I don't look at what is that wood worth today. Did it go up in value or down in value based on supply, demand, etc.? It's an insurance policy. It's an insurance policy against not freezing to death. And that's a big deal in Montana. So if I lose power, I've got a backup. I've got a generator and I've got wood. And the wood is the ultimate backup plan. So so that's the same way I look at silver. Silver is a backup plan, and if I need it, I'll be glad it's there. What will it be worth? I really don't care. It's because I'll be using it to as a means of exchange when the dollar is not useful or maybe not accepted. So just a perspective on gold and silver. Okay, Bitcoin. Bitcoin kind of hit a bottom in December and has been rising ever since, and this is a pretty big move. This represents probably a 30% move through last week. Even though it doesn't look like much, that's a pretty big move up. But will it go on up or go back down? I don't know. It looks pretty strong at this point. But I don't view Bitcoin as an alternative currency. And there are people who do. There are people who love Bitcoin. They think that this is the future of currency. I'm not in that camp. But anyway, I point it out because there are some people who follow it. And this is represented by the ETF GBTC. The next one is the volatility index. And the volatility index went up a little bit last week. And I still show the black line, which is my artificial number, that above that shows risk, an increasing level of risk, and below that shows less risk. And so we're about $19 right now, 19 versus 24. So it's still in a very favorable range, which matches with the data that I just showed you. Asbury Research. Asbury, they do the Asbury 6. This is the 6 indicators that they use, most of which are fundamental, some technical, mostly fundamental, and they're all 6 are positive. They do a cross-asset relative performance and comparing types of assets to each other. So I'll go through these, and I really look at the ones that are covered all the way across for the last week, the last month, and the last quarter. So these are all still short-term in nature. Stocks have outperformed bonds all 3 time periods. High beta, high volatility stocks have done better than low volatility. Small cap done better than large cap. Some of these relate back to the charts that we just looked at. The broad market, S&P 500 versus the blue chips, the Dow, the broad market is doing better. Technology versus the S&P 500. The S&P 500 has some technology in it, but it has many other sectors. So when technology is doing very well, it usually outperforms the broad market, the S&P 500, which is true here. And as you saw in the previous charts, growth is now, for this short-term period, is outperforming value, even though for most of last year, this was value, value, value. And in the bond area, corporate bonds are doing better than government bonds. So they both have begun rising, corporate bonds rising even more than government bonds. This chart compares the U.S., represented by SPY, the S&P 500, versus other countries and other regions. Now, if it is strong enough to merit a green box, it shows in a green box. If it's just slightly favorable, it may indicate this country or that, U.S. or this country. But so I only focus on the one that are strong enough to get a green box. So the 3 in all 3 time periods are Singapore, South Korea, and China are stronger than the U.S. I've shown this chart to show the U.S., the SPY, versus developed countries, EFA, the ETF that covers developed countries. And it has, generally speaking, been in a very strong downward trajectory. But this last week, the U.S., represented by SPY, had a little bit of an increase over the other developed countries. Gold and silver. So I've covered this in the charts, but this is the data that supports that. So through last Friday, The gold was $19.32 per ounce, silver $23.64. On top of that, you have to add the premium or the commission for the retailer in buying this. Whether gold has gone up or silver has gone up or down, demand has been incredibly high. And you can tell that not because it went up or down in price, but because the premium on it is so high. So silver is getting about a $5 premium on top of the $23.64, and gold is getting $100 plus per ounce on top of the $19.32. So gold was up slightly, which we saw, and gold and silver was down. The market is in its happy place. Thank you for watching. If you have any questions or comments, leave them in the comment section below. Thanks for watching.